Hello there, welcome to my channel. In this particular video, we are coming to look at how to prepare a 12-month rolling cash flow forecast. Alright, now this is a very critical skill to have as a financial analyst, and so we are coming to take our time and dive into it, building this particular forecast or model right from scratch. Alright, so tighten your seatbelt with me and let us embark on this journey together. If this is your first time on my channel, please subscribe to the channel. This is the Gen Z Analyst. On this channel, we look at finance and accounting topics and some key issues that affect the life of an accountant. So if you are new to the channel, please subscribe to the channel and don't forget to like my videos if you find them useful. And don't also forget to share with others so that they can also benefit from what the Gen Z Analyst is doing here on YouTube. All right, so let's get started. Now, by the end of this particular video, here are some of the learning objectives. So at the end of the video, you should be able to, one, understand and prepare a professionally looking monthly cash flow forecast in Microsoft Excel. Two, you should be able to build up assumptions, drivers, and formulas necessary to forecast the hypothetical business we are looking at. Okay, and then three, you should be able to calculate the monthly forecasts. All right. Four, you should be able to analyze the impact of the forecast on the company's balance sheet and its market capitalization. Five, you should be able to create charts and graphs to visualize your results. And then finally, you should be able to what? Learn some relevant Excel skills for financial modeling and data analysis. So here are our learning objectives. So if you are excited just as I am, then let's get started. So this is the format you are coming to use. All right, now I've built this particular format here because I have already covered this in my previous videos on building the three statements financial model, as well as building the DCF model. So I'm not going to start right from scratch building this particular cash flow forecast app. And as I said in my previous videos, that understanding the three statement financial model is the basics of the skills of a financial modeler. If you want to know how to build any other financial model, then you should have first-hand knowledge of three-statement financial model, because all the other models revolve around the three-statement model. So in this particular video, you will see that we are actually applying the three-statement model in this particular cash flow forecast. So I would advise you to go and watch my videos on how to build the three-statement financial model, which I taught right from scratch to advanced levels, so you can be able to feel comfortable when watching this particular video. So just as I said, that is what you are coming to do. All right, so at the very top here, we are having what we've indicated that the amounts are in USD, thousands of dollars. Okay, then we have our months here, the month ends. So we have the historical or the actual months, which is ranging from 31st August to 31st December. Then the forecast continued from 31st January through to 31st December. That is 12 months period. Okay, and this 12-month period is for 2025, as you can see from the formula bar here. All right, then after that, we'll have all of these I've showed how to do it in my previous videos, so you can check those out. These are then we have the next section is to look at the assumptions and drivers. All right, so when it comes to the assumptions and drivers, the first thing we are looking at is the time periods within which we are working. So we have days in a year, which is 365 days. Okay, and these are hard coded, so they should have been in blue, highlighted in blue, and just as we have this as a best practice, we always put hard coded numbers in blue font to distinguish them from formulas. All right, and I will show you how to do that with a single click. All right, so let's continue first. So we have days in the year, which is 365 days, and then we have days in the period. The days in the period, we can find that by finding the difference between the months. So we have the actual month here, 31st August, and then its previous month right there. And this will give me 31 days. So I can copy this and paste across the others. All right, so our formula is working correctly. All right, so that is what we have for the time period. So we know that at any given month, this is the number of days we are working with. All right, so that is just worth noting. Then the second section of our model or our assumptions and drivers is revenue and operating cost assumptions. So all of these we have dealt with them extensively in my previous videos. So the revenue growth rate, which is going to be used to forecast our revenue, is actually calculated using this particular formula. So as you can see, we took the previous year revenue. That is why the previous year revenue or the first month here is blank. So we've picked the next month, this current month revenue, and we divided it by the previous month's revenue, which is column C here, as you can see in the formula, and then we subtracted 1. So let me show you how that is done. So this is the blue, showing the blue here. So we have D42, which is this, and then we divide it by the previous year's revenue and subtracted 1. And that will give you your revenue growth rate. And we did it for the same, for the rest of the months. All right. Now, as you can see, when I'm scrolling down, the periods or the months under which we are working is also disappearing. So quickly, let us, what we can do um, is to freeze the panes here. So freezing the panes, we go to data, we go to view, and then we will come to under the Windows section here, you see freeze panes. So I'll come here and then freeze panes and freeze panes, so that when I'm scrolling down or even at the side, I'll still be looking at where I am working and what under what item I am working with. Okay, so let's continue. Then we have the gross margin. The gross margin is actually our gross profit divided by our revenue. Okay, as you can see from the formula here. And then SG&A as a percentage of revenue. So this is our SG&A divided by revenue. The SG&A is a negative figure in the statement of profit or loss. So we flip the sign to obtain a positive figure, and then we divide it by our revenue. So that is what we have. Then after calculating your actuals, you now use the actual figures to make a forecast. All right, a forecast. So there are many ways of doing this. One way of doing it is to actually find the average of these actual ratios. Okay, these actual ratios. So you find the average and then you use the average as a guide. All right, so that is what I did right here to be able to obtain the forecast ratios you are seeing here in blue. All right, so that's the same thing I did for all of them. The effective tax rate is as a percentage of EBIT, that is earnings before tax. All right, our EBIT right there. So let's verify that. So it's going to be our tax amount, the tax amount divided by the income before income taxes. All right, so that is how we calculate our effective tax rate. And using the average, I'm saying that our tax rate can be 30%. All right, then we have the working capital assumptions. With the working capital, we have 3 items: receivable days or receivable days outstanding, we have inventory days outstanding, and then payable days outstanding. So for the receivable days, it is our receivables figure divided by revenue multiplied by the number of days in the period or in a year, which is 365 days. Okay, so that is how we calculate the receivable days. Then when it comes to the inventory days, it is our inventory figure divided by the cost of sales figure. Okay, cost of sales figure and multiply the result by the number of periods in the year, which is 365 days. And the same applies to, okay, so I think there is a mistake here. So let's check our, okay, right there. And then for inventory days, this is supposed to be our inventory divided by cost of sales. All right, it's supposed to be cost of sales. So cost of sales is a negative figure, so you flip the sign, and cost of sales is supposed to be 43. See 43 there. So we can have our inventory days right there, which is 72. So we can change our assumptions to 72 here. So quickly, let me change that. So we have our inventory days to be 72 days right there. And then for our payable days, it is also our payables in the statement of financial position divided by our cost of sales, which we flip the sign to obtain a positive figure and multiply by the number of days in the year. So that is that about our working capital ratios. So when it comes to the forecasting of the ratios, as I said, um, we either use the average of the actuals or the historical ratios, or we can also use the most recent ratio. Okay, so when it comes to the working capital assumptions, I have used the recent ratios here. All right, that is what I used. All right, then we have the capital expenditure assumptions. With those ones, there are two items under it. We have PPE as a percentage of revenue. So there are various ways of forecasting PPE. I have covered different methods of calculating for PPE in my other videos, so you can check those out. And then we also have depreciation as a percentage of revenue. So our depreciation is also there. Okay, so this is our depreciation assumptions right there. Okay, then we have financing assumptions. You have equity issued. I've indicated here blank. So the color here is indicating that I have intentionally left it blank. All right, when you are building your model, you need to indicate it in a clear, concise way so that somebody who sees the model can be able to understand what you are doing. So as soon as I'm able to paint this particular area with a gray color there, anybody who sees it know that okay, he intentionally left it blank. When you come to the revenue forecast here, I have left this place blank intentionally, so I have also painted that so that any white space you see within the model will tell you that it is actually an error, so you need to correct it. So that is some of the best practices you incorporate into your models when you are building them. All right, then we have term debt issued or long-term debt issued. Then we have term debt interest rates. These are all assumptions. We are saying that during this forecast period, we are not going to issue any debt, and we are not going to issue any equity. We are not going to pay any dividend within this 12-month period. All right, those are the assumptions we are making. And we also have our debt to equity ratio, which is here, which is the total debt divided by total equity of the shareholders. And we also have debt service ratio covenant, which is times 5 times here. So this times you are seeing here was actually done by me. And if you want to know how to do that, just select your figures, hit Control 1 on your keyboard. Sorry. So let me undo that. So you hit Control 1 on your keyboard. That is going to take you to format cells dialog box here, and then you will see go to numbers or number and then custom. When you come to custom, you simply pick this 0.00 here and add x to it, as you can see here. Add x to it, and that will give you that x thing you are seeing there. All right, that is how we did it. The same thing applies here. So Control 1 to bring format cells window, and then you can be able to format it using the 0.00 here, X. When it comes to our working capital assumptions, we can do the same here. So usually all of these are in days, all right? They are all in days. So I can actually add days to them. But since I have receivable days here, that's why I didn't add the days. But let's see how you can do that as well. So you can hit your control 1 again to open the format cells window and come to custom. This 0 here, just bring a space, colon, and then I'll write this, close colon, and hit OK. That will add days to it, as you can see here. But this looks a bit clumsy, and since I have days here, there's no need for me to add a day, so I can just undo that. Okay, so I can just undo it, and that is it. All right, so that is it for our assumptions. Now, quickly, as we are done with assumptions, let us try and group our forecasts so that we work with one at a time. Okay, so as you can see, this is a lot down here. So here's what I'm going to do. We are going to group the various sections together, okay, in Excel. And how do we do that? I'm going to select the assumptions section first. So select up to this place, go to data, come to outline, as you can see from the top right corner here, click on the drop down, come to group, and then click on group. That is going to group this particular section of the assumptions for me. So with this, I can collapse, I can actually group it like that. All right. So I'm going to do the same for all the other sections. So this is the income statement. I'll select everything here up to my profit after tax, and I'm going to hit F4 on my keyboard. That is going to repeat the last action for me so that I don't have to go through the entire process again. And then I'll do same for my statement of financial position. So selecting everything here, I'm going to hit F4 to repeat the last action. I'll group that as well. Do it for my statement of cash flows. Hit F4 to group that as well. Come to supporting schedules. Now all of these sections, we are going to look at them in our model, but as I said, we have covered them in my 3 statement financial model video, as well as our discounted cash flow model. So these are not new things we are covering in this particular video. So with this, I think this is enough, and then I'll hit F4 as well to group that. All right, so just as you can see, we have grouped all the entire sections together. If I want to open everything here, I'll hit the number 2 here, and it's going to collapse every section for me. And then when I hit 1, it's going to bring everything back in a grouped manner. As you can see, very, very nice. All right, now we are done with assumptions. So let's come to our income statement. I'm going to collapse it. So let's start forecasting some of the figures we can forecast. All right, so with our revenue forecast is going to be the previous year revenue times, open parentheses, 1 plus our growth rate. Okay, our revenue growth rate, which is 10% here. So I'll close my parentheses and hit enter. Okay, so this is what I'm going to do. I'm going to select everything here using holding shift and the right arrow. I'm going to select the entire area here, and I'm going to format it to 0 decimal places. All right, so that is it for our forecast for 31st for January forecast. And then for our cost of sales is going to be equal to our revenue, forecast revenue, multiplied by, I'll open parenthesis, 1 minus my gross margin. The gross margin, which is 65% here, I'm going to close my parenthesis and hit enter. Okay, but this is supposed to be a negative figure, so I'll put minus there before hitting that. All right, so with our revenue and the cost of sales obtained, we can find our gross profit. The gross profit is simply the addition of the revenue and the cost of sales. Since the cost of sales figure is a negative, I'm going to add those together, and this is giving me that. So let me insert a border here. Now you can use keyboard shortcuts for this without using your mouse. So we are going to be using the keyboard shortcut as well. To obtain your keyboard shortcut, simply hit Alt. So we are coming to insert a bottom border for this, okay, as we have here. So that's what I'm going to use. So we have hitting Alt. This is going to give numbers and alphabets to the various tabs on the Excel window here. So that's what we're coming to do. Then I'll go to Home. Coming to Home, I'll have B. B is the borders, so I'll have B, and then with the bottom border is O. All right, so let's continue. Now we have our SG&A expense, that is as a percentage of revenue. So I'll pick my revenue figure and multiply that by my SG&A percentage assumption. That is 25% here. And then my depreciation. So this is also a negative figure, so I'm supposed to flip it with a sign there. And we also have depreciation expense as a percentage of revenue as well. So I'm going to put my negative sign before it. All right, and then go and pick my depreciation 10% there. So that is depreciation. And for interest expense, this is going to be a percentage of our long-term debt. Okay, long-term debt. So that is that for now. So we are going to focus up to income before interest. Okay, so with this we can copy. So with this done, we can copy this across. So holding shift and using a down arrow, I can select everything, and then holding shift again with the right arrow, I can select the entire area here and use Control R to copy across. All right, so that is that for now. All right, so we are done with our sales. We are done with the income statement for now. So let's go to our balance sheet and see what we can fill in there. So we are going to have our property, plant, and equipment. The property, plant, and equipment, the new additions is going to be as a percentage of revenue. So we are assuming that the amount of property, plant, and equipment we are going to have depends on our revenue. So it's going to be equal to my revenue figure multiplied by PP percentage here, which is 30%. All right, so that is what I'm having there. And then for my cash and cash equivalents, that is going to be from our statements of cash flows. And then for my account receivable, my account receivable is going to be equal to the forecast is going to be equal to my receivable days. Sorry, so this is the next one there. So it's going to be my receivable days from the assumptions. So what are the receivable days? I have 18 days, and that is going to be multiplied by revenue divided by 365 days right there, and that will give me my revenue forecast, sorry, accounts receivable forecast. So just as I did for the income statement, let me do same. So holding my shift and using the arrow keys, I'm able to select everything here, and then I will reduce the decimal places to 0. All right, so that is it. And then for inventories, it's going to be the same trend. So we have our inventory days is going to be equal to our inventory days, which is 72 days, multiplied by our cost of sales, and divide the result by 365 days. Okay. All right. So with that done, I can go ahead and add these together. So I'll have my alt equals added together there. And then I can also have my total assets, which is equal to, so I can actually copy the formula from here. So using Control R. So that is my formula there. All right. And then here too, I can copy the same formula. So using Control R. Sorry. Control R. Okay. So let us insert another bottom border here. So Alt H B O. That will give me my bottom border there. All right. So with this, I can copy everything and paste across. Okay. So let's continue. Then our current liabilities, we are going to have, as we have done for our accounts payables, is going to be the payable days. It's going to be our payable days multiplied by the cost of sales and divided by 365 days, which is here. All right, so that is that for our current receivables as well. So I can just copy all of this formula from here, Control R, and then also do this. And then I can copy everything from here to the right, Control R. All right. Then for the balance sheet, let me insert a few spaces here. So for the balance sheet, we are going to have a balance check, two balance checks actually, but this particular one will be down here, balance check, and the balance check is going to be at the end of the day, the total assets minus our total liabilities plus equity should be 0. All right, so I'm going to copy this across using Control R. So as you can see, the historical the actuals are showing 0 balance, whilst our forecasts are showing differences there, which means indicating that we are not done with the balance sheet. All right, so that is it for our balance sheet as well. All right, now that we have all of these, let us revise our assumption for the long-term debt. All right. So we are going to assume that this particular long-term debt at the end of December is going to continue for the rest of the period. All right, so our long-term debt is actually going to remain the same at the same $30,000. So I'm going to copy that to the right there. And then with our long-term debt determined, we can go ahead. Now, typically, you can prepare your long-term debt schedule, all right, under the supporting schedules. But in this particular situation, we are not doing that. That's why I'm saying that there are many ways of doing it. You can assume that long-term debt is going to remain the same over the entire month. Okay, so that is also acceptable. So I'm going to go with that particular system. So with our long-term debt determined, we can go ahead and fill in that of our income statement. So let's come back to our income statement and fill in that of the interest expense. So the interest expense is a percentage of um, our long-term debt. So I'll go to my long-term debt in the balance sheet, which is 30,000 here, and multiply that by the interest expense rate, our term debt interest rate of 6%. So this 6% here. And then with this, I can now calculate my income before taxes. So I'll just copy this formula from here to the right. Okay. And then also insert my border there. And with that, I can also find my income taxes. The income tax is a percentage of income before tax. So I'll pick my income before tax, bring my minus sign before that, and multiply by my effective tax rate of 30%. Okay, so that is it. And then with that, we can calculate our profit after tax, which I'm going to copy the formula from the actual here, and that is our profit after tax. So with this, I can now complete my forecast income statement using Control R. So our income statement is complete, just like that. Let's go and finish up the balance sheet, and it is the items within the balance sheet and the income statement that we use to populate that of the cash flow statement. So the cash flow statement is going to be the last thing you're going to do. All right. So before we can finish the income statement, the balance sheet, the items left are we have our retained earnings. So with our profit for the year calculated, we can now find our retained earnings. Retained earnings typically to the previous balance retained earnings plus our current year profit, which is the forecast profit here. And then if there is any dividend payments, we subtract dividend payments. But here there is no dividend payments. You have assumed that they are not going to pay any dividend throughout this particular period. So if you assume that there is dividend payment, then it should be subtracted from our retained earnings to get the total retained earnings in the balance sheet. So this is going to be our retained earnings. I can copy this formula to the right using Control R. All right, so that is our retained earnings out well. For share capital, is going to remain at 0. No issuer or no issues of share capital. And so now the only item left for us to fulfill is the cash and cash equivalent, I guess. Yeah, so we have done every other thing. Is left with our cash and cash equivalents, which we are going to get from the statement of cash flows. So let's go ahead and prepare our statement of cash flows. The statement of cash flows starts with our profit after tax for the period. So, and that is gotten from the income statement. So I'll come to my income statement and link this right there. And then the next item is to add back or adjust for non-cash items. The only non-cash item you have here is depreciation expense. So we are going to add back our depreciation expense, and that can also be found within the income statement. So it's a negative, so I'll flip the sign by putting another negative, and then I'll select my depreciation expense there. And then we have changes in non-cash working capital. Now the changes in non-cash working capital can be found within the supporting schedule. So let's go there and find that. Okay, so with the changes in the working capital we are going to have for account receivables. Now, the changes in working capital have an effect on our cash position. And this is the basic idea behind the changes in working capital. We are saying that looking at our accounts receivable, so we are going to actually start from the actual period here. So we are saying that looking at our accounts receivable, what effect does an increase or decrease have on our cash position? All right. So with our accounts receivable, we are saying that whenever accounts receivable is increasing over the period or over the months, then it means that our debtors are not paying us, and so it is having a drain on cash, and so cash is going to reduce as long as our account receivables keep on increasing. So this is what we are going to do. We are going to check whether our account receivable is increasing from our balance sheet. So these are our account receivable. In the month of August, it was 5,100, but in the month of September, it is what? 5,900. So it means it has increased over the period. And when you look at it, it has increased over time. The same thing applies to inventories. Whenever our inventories are increasing, it means we are not selling our inventory for cash. And so we are being drained on cash. And so the same logic applies to inventory. So whenever inventory is increasing, it means our cash is going to reduce. Then the opposite applies to accounts receivables, which is the next working capital item. For accounts receivable, when it is increasing over the period, it means we are holding on to cash. We are not paying our suppliers. And so that is actually what making cash available for use in the business. All right. So whenever it is increasing, it's going to add to our cash position. So that is how we analyze working capital items. All right. So with that said, let's go and complete the changes in working capital schedule. So I'll come here. For the first year, because we are considering change, we don't have anything for the we don't have a prior period figure for the month of August. So quickly we will start from the month of September. And so with that, I'm going to put a gray color here to indicate that I intentionally left that blank. All right, so let's continue. So I'm going to have the change, and since we have determined or we have established that accounts receivable is increasing, this should be a negative, it should have a negative impact on our cash. So I'm going to have a minus, and then I'll bring bracket, and this year's figure, that looking at the change, minus the previous year or the previous month figure, and then I'll hit enter. The same thing applies to our accounts inventory, so I'll just use Control D to copy the formula down. All right, and then for my account payables, it is going to be an addition to our cash position. So it's going to be 4,800, which is for the month of September, minus the month of August balance, which is 3,902. So that is actually an addition to our cash position. So I'm going to sum all of this together, and that is giving me 1702. Let's go to our historical cash flow statement and see that if that is correct. So where is our cash flow? This is the change, which is 1702. So just like that, we are able to determine that. So with this, I can copy this and paste it across. Holding shift and the right arrow, I can select the entire area here and paste this across and paste this. So I'm going to select this, copy, and paste. All right. So sorry. So that is it for the changes to working capital. So now that I have gotten my net change in working capital, I can go ahead and link that to my statement of cash flow. So I can come here and link that from here. So this is 694. We have that right there. Okay, so now I can copy this particular formula from here using Control R, and I can copy everything from there. Okay, so now let's come to the additions to property, plant, and equipment. The additions to property, plant, and equipment are those found in the property, plant, and equipment schedule down here below. So let us find that as well, and then we can continue. So what is our opening balance? Now, the closing balance is the balance from our balance sheet. So let's go and pick the balance from our balance sheet. PPE, which is 45,000 here. All right. And then the capital expenditure for the period can be found within our statement of cash flows. So we have additions, which you have here. So it's a minus, so I'm going to flip the sign right there and select that. Then depreciation can also be found both on the income statement and on the cash flow. So I'm going to flip the sign, or I'm not going to flip that. Let me pick it from the statement of cash flows and put a negative here, indicating that it is a reduction. So with these three figures found, I can find my opening PPE balance. So how do we find my opening PPE balance? It is going to be our closing balance, and then we are going to add back the depreciation here, and then we are going to subtract our capital expenditure or additions, okay, our capex. So that is going to give me 11,000 there. Now we are going to copy this across using Control R here, and then for my capex can also be copied across here, and then for my depreciation this can also be copied across. So we have this right here to be equal to the opening balance for the next month is going to be the closing balance for the previous month. So we have that, and then I can copy this as well across. All right, so that is how we do this particular one. Now let's come to the forecast period. Let's come to the forecast period. When it comes to the forecast period, we are coming to what the opening balance is still going to be, or the closing balance of the previous month, and then our depreciation can be found within our cash flow statement or our, so let me pick it from the cash flow statement here and indicate my minus there as a negative, and the closing balance is going to be the balance from our balance sheet. So let's come to our balance sheet and pick the closing balance from here. So now that we have obtained all of these figures, we are going to find our capex, or the capital expenditure, which is going to be equal to our closing balance added to the depreciation, and then less our opening balance. That is giving me 1,454. All right, so our depreciation should not be a negative figure. So we're going to change that. It should not be a negative figure. So we're going to subtract that from there. All right, so now this gives a more realistic value. Okay, so with that done, I can copy this and paste across. So let me paste across there. Okay, so we are having 000 for depreciation because I have not actually copied this across my cash flow statement. So let's copy that also across. So using Control R, I can fill it to the right, and you could see that my PPA schedule should be working now correctly. correctly. So everything works perfectly correct. So now that we have finished our PPE schedule, let's go back to our cash flow statement and fill in the figures there. So our additions is going to be found, and this will be a minus. So we have that there. Can copy the formula from here across, fill the bottom line there, and then I can copy this, select all of this together with the area, Control R to fill right, and then for these issuance and repayment of debt, we are assuming that they are all going to remain at this state as with the previous figures. So I'm going to copy this across, have my bottom line there, and then I can copy this also across. Okay, so I think we are almost done. We are almost done with our three statement financial model. Now, all that you are doing, you are just building a three statement financial model. All right. And so, if you want to understand this from scratch, you can watch my previous videos and come back to this and come and watch it, and you understand whatever I'm doing here even more. All right. So, we have our cash generated for the period. So, the cash generated for the period is going to be that. All right. So, we have cash and cash equivalent at the beginning of the period. Now, we have cash used or generated in the period. That is going to be the addition of the three cash flow items. Okay, so we have cash generated from operating activities, we have cash generated or used for investing activities, and then we have cash used for financing activities. The addition of these three items will give us the cash used or generated in the period. So let's go and find the total for that. Or I can just copy the formula from here to the right. And that is giving me that. Then we have our cash and cash equivalent at the beginning of the period. That is going to be equal to the balance at the end of the previous month. Okay. And then I can copy this to the right. That's going to be the addition of that. And then with this, I can now copy everything across using Control R. So now we have filled in the cash flow statement as well. So let's go and complete our balance sheet. So with the balance sheet, I'll go and link my cash and cash equivalents from the cash flow statement. So I have this. Let's see if, so this is still giving me a balance of 170. All right. So this is where it is coming from. So let me fill in everything and see what that gives me. So I'm going to fill everything here to the right. And this is giving us the equity balance. So per the assumptions we are making, we should assume that the equity balance is going to also remain just as the debt remains the same. So the equity will remain the same. So we can copy that also across using Control R. And that is going to give me this particular balance right here. Okay, so as you can see, our balance sheet balances correctly. Now we can make this balance check more robust. So when you come to the top of the statement, I have put balance sheet check here. So we can put another check here so that we can use that as a guiding principle or as a more robust check. So we are going to use Excel formulas to do that. So let me actually unfreeze the panes and refreeze it again. So I'm going to unfreeze the panes and then refreeze it. Okay, so let's go to our balance sheet check. This is how we are going to do it. We are saying that at the end of the day, if, so we are going to use the if function. If, then the first argument for the if function is logical test. So what are we testing? We are saying that if the absolute, so we are going to use the absolute function as well inside the if function, and the number is asking for number. That's the only argument there. So we are saying that if the absolute difference between our balance sheet figures which are the total assets minus the total liabilities plus shareholders equity, I'll close the bracket for absolute, is greater than, so I'll bring my greater down here, 1, then comma. Now the second argument under the if function is saying value if. So value if true. So if the absolute difference between my balance sheet totals, all right, is greater than 1, then we are saying that if this is true, if this is satisfied, then put error. Okay. Otherwise, if the absolute difference between the balance sheet figures is not greater than 1 or is equal to 0 or less than 1, then you should see what? Okay. So just put okay there. Just put okay there. And then I'm going to close my parentheses and hit enter. So it's saying okay, yes. So we have okay there. And then let me format this, italize it, and also give it a different red font color there. So with this I can copy it across my model. Okay, so it is showing okay. So that is how the this is how you introduce robustness to the cash flow forecast or model. All right, so that is a robustness check there. So any changes we are doing, if it affects the balance, we can quickly view from the top here what is happening to our model. All right, so that is that. Now let's come to the other side of, so we have an information here that we are going to fill. Now that we are done with the three statement model, let's focus on the analysis of our cash items and their effect on our balance sheet and the capitalization of the company. All right, so let's come to debt service ratio. We are coming to calculate our debt service ratio. Now the debt service ratio is calculated as EBITDA, which is earnings before interest, taxes, depreciation, and amortization, divided by our total debt service. That is the total debt we are going to pay plus interest. All right. Now, from the assumptions we have made, we are not going to issue any debt for the period. No new debt is going to be repaid in the period. Okay, there's going to be no issuance of debt, so we are not going to have any big, so the only debt service we are going to have is our interest payments, which can be found on our income statement. So let's calculate our EBITDA. So what's the EBITDA? EBITDA is what? Earnings before interest, taxes, depreciation, and amortization. So what do we have? We already have EBIT within our income statement. So I'm going to have so we don't have EBIT too. So this is how we calculate our EBITDA. I'm going to take my gross profit, add back. Okay, this is earnings before interest, tax, and what? interest and tax. So this is what I'm going to have. I'm going to have my gross profit, add my SG&A expense, which is actually a subtraction I'm making, and then I'm going to subtract my depreciation expense. I'm subtracting depreciation expense because depreciation expense is a negative sign here. So actually, I'm supposed to be adding it back. Okay, supposed to be adding it back. As soon as I do that, I'm going to have my EBITDA figure here. All right, so that is our earnings before interest, depreciation, and amortization. Then our total debt service, as I said, there is not going to be any um, issuance of debt throughout the period, as we can see in our statement of cash flows here. So the only debt service we are going to have is our interest payments, our interest expense here. So I'm going to flip the sign there and select my interest there. All right, so with that done, I can now calculate my debt service ratio. Debt service ratio is EBITDA divided by my debt service, total debt service, which is 18.4 times here. Now, what is the debt service? The debt service is talking about the amount of debt we are going to plus interest we are going to pay over the period out of our cash. Now, when we are dealing with cash, EBITDA is very important. It takes into account non-cash items. All right, that is why it is before interest, taxes, depreciation, and amortization. Most of these items have what non-cash elements within them, except for interest. Okay, so that is why we use this particular income or revenue stream when we are determining our debt service ratio. So that is our debt service ratio. Now, the debt service ratio covenant is what? The agreement we have made with our debt providers that, okay, um, the debt service ratio for the period should not exceed this particular covenant. And that covenant, we have made an assumption within our assumptions section. So this is the debt service ratio covenant. So it shouldn't be what? Less than this. Our debt service ratio shouldn't be less than this. That means that we are paying what? We have enough to pay our debts that have been not accrued for the period. All right. So that is it. So it means we are within this covenant. We are within this covenant. So with this done, I can now copy everything here across, and that is going to be reflected in our charts and graphs. All right. Now our charts and graphs. Okay. So let me just check this and see if that is working correctly. So we'll add our SG&A expense, and then we'll add back our depreciation expense. All right. Okay. So we have that working for us. So we are done with all of that. Now let's summarize everything using charts and graphs. Okay. Let's summarize everything using charts and graphs here. So with the charts and graphs, we are going to have two items. So under our charts and graphs, we are going to have what? A cash flow summary, or a cash flow summary. And with the cash flow summary, we are going to pick items like operating cash flows. We're going to have investing, the three main cash flows. So investing cash flows and financing cash flows. And then lastly, we are going to have what? Our monthly cash balance. All right, so let's go to our model and fill that information. So all of these can be found within our all of these can be found within our income, our statement of cash flows. So what is cash generated from operations? Okay, so this is what I'm going to have. This is supposed to be this. So let's go and pick those figures. So cash generated from operations, this one. Cash from investing, this. We have cash from financing, that. And then we have our monthly cash balance, which is the cash and cash equivalent balance at the end of the period. So those are our monthly figures there. Okay, so we can copy this and paste across and paste this across. All right, so those are our cash flow information, summary of it that we're going to use for our cash flow chart. So the next items we're going to look at, as I already said, is the debt service ratio, as well as the debt service ratio covenant. The debt service ratio covenant. So what is our debt service ratio? You can find that from our supporting schedules. So I can have this and copy this down and also copy it to the right using Control R. All right. So now that we have determined this, let's go ahead and graph the results. So the first chart is going to be, let me do this and also change that. So I'm going to have, the first chart we're going to have is the monthly cash flow chart. And then the second graph or the second chart, let me see if the space is enough. Okay, the second chart is going to be, so let me merge this and use this and then also change this to this. So the second chart is going to be our debt service ratio and covenant. All right, so these are the two charts we are going to have. So let's go ahead and build the cash flow summary chart. So I'll come here. Now the chart is necessary because it gives a snapshot of what the cash position for the entire period looks like. All right, so that is why there is a need for us to graph our results on the chart. And so to do that, we're going to use the let's go to insert. We're going to insert, come to recommended charts, and then with the recommended chart, I'll come to all charts, come to combo. All right. Okay, so I think selecting the stacked column for the financing cash flows is better. So let's select this particular combo chart and see what we have here. So I'm going to pick this, bring it here, and resize it nicely. resize this nicely. Now, since we have a chart title here, I'm going to select this and press delete on my keyboard. And also the grid lines here, I can select one of them and press delete to be able to have a very good look at my chart. All right, then let me resize it again a bit. Now I want the screen to be a bit bigger, so let me show tabs only here. Good. That's good. All right. Now, this is our monthly cash flow forecast. Let me resize it nicely. Now, this is our monthly cash flow forecast. If you like, you can play around this and change the width size of the bars here. So you can just right click and then you can come to format data series. When you format the data series, you can come here and increase the gap width or reduce it for it to be a bit bigger. I can come here and do same, or you can even come here and do play around whatever you want to do with it. Okay, then so let's leave it for now. And then for this, I'm going to, for consistency's sake, I'm going to change the fill color, the outline to this blue here. Okay, and then this can remain like that. Then what I will do is to change. I'm going to select this, bring them up here nicely. Bring them down here. Okay, and then for this particular aspect, the numbers you are seeing here, I'm going to change them. So format, select data there, and then for here, I'm going to edit it and select the range. So the range is going to be my months. Okay, so I'm going to select all the months here at the top and hit OK and hit OK, so that we know that the chart actually represents the months there. So this is 1st August, 1st September, 1st October, up to that. All right, and then here too, these are supposed to be my cash flows, so I'll leave them like that. So this is actually giving us a snapshot of what is happening. Now let's look at the key here and see what we have. So here is our operating cash flows. So when you look at it, our operating cash flows have been growing over the period. Then our investing cash flows, let's look at it. This has actually been below zero, which means they are into negative figures. So we must look at what our investing cash flow activities, okay, as well as the financing activity. For the financing activities, in the month of September, it was very high, and then for November, it's negative, and then from that onwards, it has been zero. So we need to look at our financing cash flow activities. And as you can see, our monthly cash balance has been increasing very significantly. So we can what? Use this the growing or the increasing monthly cash balance to what? Finance our investing as well as our what? Financing cash flow activities. This is why it is very important to draw up a chart that will summarize everything for you. All right, so that is what we have. Then let's come to, so it seems there is enough space here, so I'm going to delete this plenty space. All right, so let's come to the debt service ratio as well as the debt covenant, the debt service ratio covenant. All right, so just as we did for the monthly cash flow chart, we are going to do same for these eyes as well. So selecting everything here, you can go to insert, come to recommended charts, and I can pick let me see combo here. So instead of debt service ratio, for the debt service ratio covenant, this should be a line chart. This should also be a line. Let's see, good. So we have that. So with this, I can click OK and bring this particular one also here. So let me move it to its rightful place. So I'm going to move it down here. Okay, and then I'm going to resize it nicely to this place. And the chart title is already here displayed. So I'm going to click on that and delete it. So delete it, and then also delete these grid lines which are interfering, and then I also moved it to the top. All right. Let me resize this and bring it down rather. Put it at the top here. So from this, let me also change the outline to my recommended blue here. And this as well. I can change it to this gray color here. All right. And then finally, let me also change the data label here. Select data there. And the data label is supposed to be the months, so I'm going to select all the months here and hit OK. Hit OK. So we have that there. OK. Let me change the outline to this dark gray there. All right. So that is what we have here. So looking at this at a glance, we know that we are what? Fulfilling the debt ratio, a debt service ratio covenant, which means that our debt servicing has been constantly increasing high over the across the months. Okay, so that is what has been happening, and this gives a snapshot of whatever we have been doing with the debt and then the amount of cash that we have available. So I've been using it to service our debt. So as you can see, the charts have given us what? A snapshot of everything we have done within the monthly cash flow forecast. All right. So this is how we build a monthly 12-month rolling cash flow forecast or cash flow model within Excel. All right. I hope you have studied a lot. Let me see if my grouping has actually covered the entire row there. Okay, so this is a flop. So I already have this. So what I will do is to delete those. Oh, sorry. And then I can insert my group now. So I'll come to data, outline, and group right there. Okay, so now that I've grouped everything, I can just click the 2 here and it's going to what? Group everything back into its place. So number 1 there is going to group everything back to its place. So this is how we build the monthly cash flow forecast. So in this particular video, what have we done? We looked at the structure of the monthly cash flow forecast. So we look at the actual months and then our forecast months, which is a 12-month period from January to December. And then we looked at assumptions and drivers to drive our forecast. And then we calculated some ratios, accounting ratios, including working capital assumptions, tax assumptions, capital expenditure assumptions, financing assumptions, and then we looked at our debt to equity ratio and all that. And then we build our three-statement financial model by looking at the income statement, completing the balance sheet or the financial statement of financial position, and then we also build our cash flows. And then with that, we have some supporting schedules to finish up the balance sheet and also to complete the cash flow statement. And we finally summarized our results using some summary charts and graphs. Okay, so this is what we have covered in this particular video. If you have followed me from the beginning to now, you should be able to build a monthly rolling cash flow forecast from scratch, especially if you have watched my previous videos on how to build the three-statement financial model, because this video has basically builded upon the knowledge of building the three-statement financial model. So if you haven't watched that video yet, I encourage you to go and watch it and come back here and do what is necessary. All right, so thank you very much for your time in this particular video. I hope you have studied a lot. Please subscribe to the channel if you haven't done so, and also consider liking the video and sharing it with others so they can also benefit. Thank you. I will see you in my next videos.